Good morning and welcome to today's webcast, Strategies to Improve SOX 404 Compliance. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I am pleased to introduce today's presenters. Francisco Sarmiento Jr., Partner, and Matt Doxtator, Senior Manager. Francisco is a Risk Advisory and Compliance Partner at Moss Adams. Based in San Francisco, California, he has been in public accounting since 2002. He specializes in Sarbanes-Oxley compliance, enterprise risk management, internal audit, and forensic accounting for domestic and multinational companies in various industries. He assists clients implementing their risk mitigation strategies through process enhancements and efficiency reviews, internal audits, and management of the client's SOX 404 compliance program. Matt has provided outsourced management consulting and internal audit services across multiple industries since 2005. In addition to serving clients in public accounting and consulting, he's held Sarbanes-Oxley Act and internal audit leadership positions for organizations subject to SOX 404B requirements. He has led every aspect of the SOX 404 compliance and internal audit processes and has managed significant SOX 404 assessment projects from initial implementation to final reporting. With that, Matt, I will turn it over to you to get us started.
All right, thank you very much. Hi, everyone, and thanks for joining us today for this discussion on strategies to improve SOX efficiency based on the response rate for the invites that were sent out. We know this is a highly charged issue, and here you can see our objectives. Our goal today is really to provide some context on how we got to where we are with SOX cost and effort, and to provide some low or zero cost strategies for improving the efficiency of your SOX programs. We'll also provide some background on the compliance requirements and different models for compliance to set the stage for our recommendations. For today, we're sticking to shorter term and hopefully budget neutral recommendations. There's a lot of discussion on investment in technology solutions like GRC systems and tools for automation, which may lead to increased efficiency, but we're going to stay away from that today. We could spend a whole day on that, and we understand that additional technology investment just may not be practical for some folks. So for our agenda, we'll provide an introduction, talk about SOX pain points and root causes. Then we'll briefly cover the rules, including the difference between SEC and PCAOB requirements. Then we'll talk SOX delivery models and SOX phases and activities in order to tee up the rest of our discussion around what you as management can do about it to reduce your costs and effort while still maintaining compliance. So with that, we're actually going to start off with a polling question because we'd like to get a feel for which of these SOX pain points you've experienced. And if the answer is none, then please make sure to leave your contact information because I want to hear how you actually did that.
All right. Our first polling question: which of the following SOX issues has your organization experienced? And your options are A, the cost just keeps going up with very little return on investment. B, we can't hire or retain personnel with the right expertise. C, there is no coordination on testing and we have duplication of effort between external and internal assessments. D, the bar for compliance seems to be continually raised and we're always being asked to do more. E, the SOX process places undue burden on our personnel. Or F, other, and if you'd like to let us know, you can send us your other option in the Q&A. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and make sure to hit submit. Just another minute on this first poll. All right, and let's go ahead and take a look at the results. Back to you.
All right, so it looks like a couple of the popular choices had to do with the cost and sort of the perception that we don't get a whole lot out of that other than being compliant. And then the other one was we just keep being asked to do more, which is something that we are seeing a lot and something that we'll touch on here in a second. All right. So here you can see some of the common SOX pain points. In summary, it's expensive and time consuming, right? When we first started preparing for this presentation, we had a planning discussion and Francisco actually suggested the best way to minimize the impact of SOX compliance is to not be public. Unfortunately, organizations need public capital to grow, and it comes with a very steep compliance price tag. Here are a few of the common SOX pain points. What makes these even more frustrating is, as you all agreed, the perception by a lot of companies that there's just not a lot of return on this investment other than us being compliant for another year. Now, before the comments blow up, we're definitely not going to get into the debate about the merits of SOX or whether it delivered on its promises. We can save that for another day or for a happy hour. So we want to talk briefly about the underlying causes for some of those pain points. And because these are really important to keep in mind when you're trying to optimize your SOX program. One of the biggest ones is PCAOB scrutiny. Auditing public companies is extremely high risk. The PCAOB is charged with audit quality, so they are continually raising the bar on inspection criteria. Auditors are pressured to increase the rigor in their audit of internal control. Now, the goal is audit quality, which is important, but unfortunately, management ends up paying the price in terms of increased documentation requirements and this continually moving the goalposts. Of course, we also have to deal with regulatory changes like recent cybersecurity disclosure requirements, and everyone's favorite topic, ESG. Additionally, as business becomes more complex, financial reporting requirements have to as well. More and more, complying with GAAP requires specialization and reliance on third-party experts. Similarly, companies are becoming more reliant on third parties for their technology needs as well. Finally, a lot of companies don't have adequate IT environment to support SOX. IT organizations with limited resources can get overwhelmed when asked to deal with SOX requirements on top of the day-to-day administration of their operation systems. So here, we're not going to spend a lot of time on this because the folks on this call don't need to be reminded of the cost of SOX. But here's a look at annual SOX compliance costs based on the 2023 Protiviti SOX compliance survey. The results actually showed a decrease in compliance costs per location, which is great, but as you can see, SOX remains a significant expense. For example, accelerated filer, somebody with maybe 250 million of revenue could be paying nearly 900 grand in SOX compliance costs, not counting those costs associated with the external audit of internal control. That's over 1/3% of all their revenue. And of course, some years it can be much more. As mentioned here, there's some significant cost spikes during transitional years, going from 404A to B, or moving out of the emerging growth category, which we'll talk about here in a second. Even if SOX costs aren't necessarily growing at the rate they were, the time investment does appear to be increasing. 60% of respondents to that same survey reported their SOX hours went up year over year, while only 14% reported them decreasing. And over 2/3 of large accelerated filers, reported increased hours year over year. So the time commitment is still going up, and it's a big concern. A couple notes on PCAOB scrutiny. As we mentioned, one of the biggest drivers of the increased hours may be the increased pressure from the PCAOB. Despite all the efforts to increase audit quality, based on a preview that was issued by the PCAOB, the board expects a 40% audit failure rate for its most recent inspection cycle. This is up from 34% and 29% over the previous 2 years. This means that 4 out of 10 audits inspected, the PCAOB concluded that the auditor did not obtain sufficient appropriate evidence to support its opinion. Doesn't mean the opinion was wrong. It means the PCAOB didn't feel that the firm complied with the standards. 2 commonly cited reasons for failures are: 1, insufficient assessment of financial reporting risks, so risk assessment, and 2 is insufficient evidence regarding the design and operation of internal controls. So the latter, a lot of times, is related to these management review type controls, the ones that require significant judgment or involve estimates or reasonableness, and controls around information systems and the data they produce. The increased pressure on auditors has led to increased pressure on issuers to produce more and more documentation and to add new controls. So we're seeing these non-statutory precedents emerge. And what I mean by that is auditors may require clients to perform additional control activities or prepare more documentation that satisfies the auditor's quality control requirements, but isn't necessarily needed by the company to prevent or detect material misstatements. Once they've established those activities, the company has to perform them every year, and that list typically grows. It certainly doesn't ever shrink. Regardless of what the standards say, there's a natural tendency to more heavily scrutinize documentation and audits that have a higher likelihood of being selected for inspection, right? It's just human nature. In some cases, this results in requirements being put on the client that aren't necessarily essential to support the opinion, but are a little bit more of a sort of CYA exercise, for lack of a better word. So with that being said, at this point, I'm sure you're thinking, yeah, that all sounds right. We're very aware of those things, but what the heck can we do about it? So I'm glad you asked. That's what we're going to spend the remainder of our time talking about. We want you to walk away with a better understanding of the rules and what your requirements actually are. We want you to take another look at your SOX model to make sure it's the right fit, how you actually administer your SOX program, and then to provide you with some phase-by-phase tactics to increase your efficiency without adding headcount or new technology. But first, I think we need to make sure you're still awake. So Emily, is there another polling question?
There is. We have our second polling question. How familiar are you with the various sources of guidance influencing SOX compliance requirements? And your options are: A, I'm an expert in both the SEC requirements for management's assessment and the PCAOB requirements governing audits of ICFR. B, I don't really understand the difference between the requirements of the SEC and the requirements of the PCAOB. C, I pretty much only know that SOX 404 is a thing I need to deal with. Or D, I'm just here for CPE. So we'll give everyone a couple seconds to think about that. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. So just another moment here. All right, let's go ahead and see where everyone's at. Back to you.
Great. Looks like we have a good mix of people here, so that'll be great. I'll cover the rules. So thanks, Matt, for the introduction. for the first part of our presentation. So we'll just do a quick review of the relevant rules regarding SOX 404 compliance. I assume everybody here is very familiar with the history of SOX that was passed in 2002 after all that scandals with Enron and Anderson. So we'll just focus on some of the relevant rules as it relates to the 404 compliance program management. So here you'll see a comparison of a SOX 404A and 404B. I assume most of you know the difference, but 404A deals with management's responsibility. This is about your Section 9A disclosure, where you disclose your management assessment of its internal controls over financial reporting as of the most recent fiscal year end. SOX 404B provisions are those that are related to your external auditor. So it requires the registered public accounting firm that prepare or issue your financial statement to attest to and report on the assessment made by the management of the issuer. It specifies the attestations made under the subsection, which must follow the guidance set by the PCAOB. It specifies that the ICFR is the subject of a separate engagement. So there is a separate opinion on the financial statement, and also there is a separate opinion with regards to the internal controls over financial reporting. Okay, and then here you'll see a bit of an overview of the different filing status and whether they are required to comply with 404A and 404B. So initially there is only three categories: the non-accelerated, accelerated, and large accelerated filer. And then in 2010, with the Jobs Act passing, they created another category called emerging growth company, that gave company 5 years of a ramp-up period before they have to comply with 404B requirements, assuming that they stay within the limits of public float, and revenue, and public and debt. And then in 2020, they added another category, which is the SRC, or small reporting company, to give a bit more of reprieve for companies who have a smaller public float and also does not have a lot of revenue. So you'll see here, if you're an SRC and a non-accelerated filer, you will be exempted from the 404B. You only have to do the 404A, which is the management assessment. And the category for that would be if you have a public float of less than 75 million and no revenue, or you have a public float of between 75 million to less than 700 million, but your revenue for the most recent fiscal quarter is less than 100 million, then you qualify under an SRC and non-accelerated filer. You don't have to do 404B. And then if you are an SRC and an accelerated filer, which means you have a public float of 75 million to less than 250 million, but you have a revenue of 100 million or more, then you have to comply with 404B. If you become an accelerated filer, that is a company with a public float of 250 million to less than 700 million, but and an annual revenue of 100 million or more, same thing, you have to comply with 404A and 404B. Larger accelerated filer, regardless of whether you have revenue or not, that is a public float of 700 million or more, you have to comply. Or if you're an emerging growth company, if your public float is less than 700 million, and annual revenue is less than 1.235 billion, then you are also exempted. The measurement date on the public float is the last day of the trading for your second quarter. So if it's a 12/31 year end, then you have generally a June 30, whatever your public float is, which is your market cap plus your insiders. And then the revenue is measured based on your last fiscal year. So there's a bit of a two different measurement period there. One is the second quarter and one is the most recent fiscal year. Okay, we will jump into our next slide, which is a comparison of the SEC guidance and auditing standards 2301. So under the SEC Interpretive Guidance 3810, this is kind of the guidance that management uses for its self-assessment, which gives you a lot of leeway and flexibility in how you assess management's internal controls over financial reporting. It does not require management to perform quarterly testing. It can rely on management's knowledge of the operation of the controls and its knowledge based on the monitoring of its operating effectiveness. So this is very useful when you're doing a 404A assessment. So when you're only doing the management part of the assessment. Then we'll move on to the auditing standard 2201. So if you're familiar with auditing standards before, this is the guidance that issued by the PCAOB to basically give prescriptive rules to the external auditors of what they should be doing when they're assessing internal controls. So management assessment under SEC interpretative guidance is very principle-based. When we go to the PCAOB standards, it's very, very rule-based. It's very, very prescriptive and specific of what the external auditor has to do in assessing its internal controls. So when you're 404B, your external auditors, not management, will have to follow the AS2201. So the challenge there generally is finding the balance of how can we leverage on SEC interpretative guidance and then at the same time comply with external auditors, and that's kind of wherein the rely versus non-rely would play into the mix. But the rule is your external auditor has to follow the PCAOB. Management doesn't have to, but in a way, it indirectly have to follow it because in order for your external auditors to rely on the internal auditors' assessment, particularly if they're relying on management on some of its testing, they have to follow the PCAOB guidance at the same time the external auditors' requirements. Okay. Then we'll just do a very quick overview of the various SOX compliance delivery models that's available for the companies. But before we do that, we'll have another polling question.
All right. Our third polling question: which SOX delivery model does your organization currently employ? And your options are A, fully insourced, B, staff augmentation, C, co-sourced, or D, fully outsourced. So everyone take a few moments to make a selection here. And as a reminder, if you would like to receive CPE credit for today, you will need to respond to at least 3 of the 4 questions. And for those of you that would like a copy of today's slide deck, you can download them from the resources widget below the slide view. We'll also be sending the slides via email after the webcast. So I'll close it out in just a couple of more seconds here. All right, let's go ahead and take a look at the results. Back to you.
Hey,
Francisco, I think you may be on mute.
But before I jump into the next slide, I think I'll answer one of the questions that was raised. Question was, can you trigger the threshold for 404B 1 year and then not on the next, or once you trigger it, you stay in that status? The measurement for the public float and revenue is done every year. So you can exit a status and change it year over year, but the exit requirement is 80%. So you basically, let's say you're an accelerated filer and you have a public float of 700 million, in order for you to exit the large accelerated filer status, your public float has to fall below 560 million, which is 80% of the 700 million. Same with the revenue requirements. The exit requirements for revenue is 80% as well, so it has to fall to 80 million, below 80 million. Okay, so now we'll move on to the different SOX delivery models. So you have the in-house, co-source, staff augmentation, and fully outsourced. So in-house, you basically do all of the work in-house. You have an internal audit or a SOX team that delivers the work. Very good model for very mature and large companies because you can result a lower cost as you have a team of employees. The teams can be part of management and can develop rapport very quickly with the team. The drawback there is it could result to some of the knowledge becoming stale if the team does not keep in touch with the non-stop changes or the continuous changes on the requirements of SOX. And then there's also human capital aspect of it. As you know, there's a lot of turnover, particularly in the Bay Area. People jump into different roles every other year. So it's sometimes become a challenge when you have a team that keeps on changing. Co-source model, basically you portion of the project is managed internally. Usually that's the project management risk assessment, scoping, the design, and then you outsource a portion of it. So depending on what the need, obviously that is a good model. If you have an internal team that can develop the rapport and also manage the outside engagement team, it can balance the cost between your external costs and your internal costs as well. So that's another model. So and then the staff augmentation, very similar to co-sourcing, but basically on a staff augmentation, you have a very specific activity that you outsource to a third party, and most of the time that is testing, because you want to manage the peaks and the valleys of the SOX 404, because there's specific time in the year wherein there is a lot of testing that needs to be done, and most of the time under staff augmentation, the responsibilities that are outsourcers mostly related to testing. It's when you don't have the capacity or you don't have the expertise to execute a specific testing, like IT general controls. Then the fully outsourced model, that's where most of my clients actually fall into. That we come in and kind of manage the entire SOX 404 compliance program. This is very good for companies that are kind of smaller and starting their SOX 404 compliance. It obviously has its drawbacks in terms of the cost, and at the same time, there is also some turnover in the internal team. But that's very good for a smaller size company, because at least it provides predictability on the approach, and also will have develop a bit more of independence and objectivity in your assessment process. Okay, so again, just depending on your, again, resources, on your appetite, you can design whatever SOX delivery model that you have. What is important is you determine the management's need and evaluate what is the most cost-efficient way of delivering your SOX 404 program. Okay, and then I'll turn it over back to Matt for the SOX phases and activities.
And of course, Matt's on mute. All right, now that we've laid the groundwork, let's get into what you can do about it. Real quickly, we want to discuss the phases of SOX compliance so we can talk about how you can address each one. All right. So here's sort of a pretty overview. As I think a lot of you know, it starts with phase one, right? The project planning and risk assessment. This is the top-down process that includes establishing materiality, determining the in-scope entities, locations, processes, systems, and accounts. The real goal of this whole process is to identify financial reporting risks that could result in a material misstatement, whether that's individually or combined. That's it. Then in the control design assessment phase, phase two, companies document their processes and internal controls. They assess whether those controls are properly designed to address relevant risks, and then they remediate design gaps if they come up. Once controls are documented and design has been assessed, we move to phase three to test whether controls are operating effectively. Operating deficiencies would also need to be remediated throughout this process if applicable. Finally, at the end of the process, unremediated deficiencies are evaluated for their impact and the likelihood that they could lead to a misstatement. And the overall effectiveness of internal control is assessed. That's the 4-phase process. All right. In each of the first 3 phases especially, there are a lot of opportunities for increased efficiency. We'll start with risk assessment, which is critical for ensuring the other phases of the process are effective and efficient. If you blow it in the risk assessment, whether that's scoping in things that you didn't need to or missing things that were critical, the rest of your SOX compliance will either be ineffective or inefficient. So some things to consider. Part of the risk assessment, you have to, as you know, companies have to calculate materiality, which starts with a dollar amount, right? Typically some measure of financial performance or position, like a percentage of revenue, a percentage of total assets. It is important to consider each year whether the basis for your materiality is still the best measure, especially if your circumstances have changed. For example, a life sciences company that may have based materiality on operating expenses during its pre-revenue stage. Now it might make more sense to base materiality off of revenue or off of total assets or something like that. It may not, but it's important to revisit whether materiality basis should change. You should also consider whether certain previously scoped in accounts are still significant. Has something changed in the business that would preclude an account from being significant? Maybe the company had risks in prior years related to contingent consideration payable, like from an acquisition. But if there are no current arrangements and there's no planned acquisitions, the account and the related risks are no longer relevant. Along the same lines, you should revisit whether the related business processes and sub-processes are still relevant. For example, income streams may no longer be material, so that entire sub-process may not be in scope for SOX anymore. Most importantly, keep in mind that risks tend to get rolled over from year to year, but those risks that could no longer reasonably lead to a material misstatement should be scoped out. Another major area to pay attention to is whether your in-scope systems need to be revised. Each system included in the scope for SOX during phase 1 adds significant time and costs to the later phases. So it's critical to reevaluate this list every year. Not only should you consider whether the system still impacts financial reporting significantly, you should also evaluate whether there are already manual business process controls in place that validate the information coming from these systems. This could mean that there's actually no IT dependencies because there's already controls around the information. We see this a lot, and as long as these compensating controls are operating effectively, the system itself may be able to be scoped out. And here's a shameless plug. The system scoping, this is an area where your third-party consultants can add a lot of value, especially if you don't have strong internal IT expertise, and the cost savings down the road from having them out of scope can be significant. It's also important to consider whether the scope of certain systems should be limited. There are 4 major IT domains: security, change management, computer operations, and the system development lifecycle. Some applications only indirect financial reporting. They're not actually used to authorize, process, record a transaction. So they may only be in scope for one domain, like security, for example, as opposed to all the domains. Some firms refer to these limited scope systems as like tools. Ultimately, systems that don't support a key application control or produce information that's used in financial reporting and the related controls should not be scoped in. All right.
I have a couple of questions on scoping. So the first question we have, who determines what applications are in scope for SOX? And they said, I think one of our viewers said our external auditors continue to expand the scope beyond what we believe is relevant to ICFR. And I think I can respond to that. So generally, when you're scoping system, it is a combined effort with management and the external auditor. The external auditor have to do their own assessment under 404B. But what is important is for management to provide an insight of how the tools or systems are being used and evaluate whether it's material to the organization or there are other controls in place that would allow you to rely on the data or the report coming from the system. Good example of that would be Concur. Generally, the thought process is, okay, you have expenses, then Concur should be in scope, but you have to evaluate what is the materiality and what is the amount of expenses that flow through Concur throughout any given year, and you can evaluate based on that whether it's significantly material, and if it's not, then you can scope it out. The other thing that you have to look at is if you're relying on a system and you're using a report from that system, but there are other controls that verifies completeness and accuracy of the data. For example, you're reconciling the data from the report from another in-scope system, then you may be able to scope it out. So it is a bit of a negotiation and discussion with your external auditors to determine what IT systems are in scope. But it's very important to really kind of dig into it because you can see a lot of savings if you agree on a limited set of system. The other question we have is, can the SOX auditor provide the details of how they consider materiality for the institution? The external auditors cannot give you the materiality number itself, but they can give you some guidance on what are the bases they're considering. Are they basing it on the revenue? Are they basing it on the operating expenses or net operating loss? The your SOX auditor, if you outsource it, has to share that information with you, because at the end of the day, management has to approve the materiality for your own self-assessment. For the 404B assessment, external auditors generally will not share that with you, but they will share you some insights of what basis they're using. Okay, well, Matt, thank you for that. And you can, I think, proceed with phase 2.
Perfect. Thank you. So we'll talk about the design phase. Because the SEC requirements are not very prescriptive, there is a lot of opportunity to improve efficiency here. And actually, I'll just go ahead and I think there's another question that was the first question of the day that we'll tackle here in a second. I'll just go ahead and address this one. So the question was, is walkthrough mandatory for SOX? The external auditor is not relying on controls related to the SOX process. And if the process didn't change, are we still required to perform a walkthrough? So spoiler alert, because this is on some of the following slides, but the short answer is, for management's assessment, the SEC does not give any specific requirements for walking through controls. The only requirement is that management assesses the design of their controls. And if there is and it also doesn't specify what level of documentation is required for the assessment, just that it has to be documented. So if there's been a evaluation of the processes and the conclusion was these processes and the related controls and the risks they're addressing have not significantly changed, then a walkthrough is not necessary. The conclusion should still be documented as to the rationale for not performing more detailed design procedures, but walkthroughs aren't necessary, especially if the auditors aren't relying on them. And Francisco, I don't know if you wanted to add anything to that.
Yeah, the requirements for walkthrough is required for external auditors because the PCAOB requires them to do so. So if there is a reliance on the walkthrough, generally management can perform the walkthrough, assuming the external auditors will be able to rely on it. But if there is no reliance, there is no requirements to do any formal walkthroughs. It is still important to consider walkthroughs for controls that have changes or any high-risk areas. But again, it's not a requirement. It's something you can skip, but it might be a good idea to perform on some of the controls that have a high history of failure or there is significant changes that happen to them.
Yep. And AS 2201, the PCAOB requirement specifically uses the term walkthrough. So it is definitely an auditor requirement. All right. We won't dwell on this next slide, but we provided it in the deck more as a reference tool. It's included in here because it's a handy guide to understanding the various approaches to conducting and documenting the assessment of control design. These are going to vary based on the size and complexity of your organization and, like Francisco mentioned, the requirements of your auditor. So, for the interest of time, we'll include this in the materials, but we're not going to spend a ton of time on it. So here are a few areas to dig into as you evaluate your phase 2 activities. Some things you may want to ask yourself: how detailed should your documentation be? When I say documentation, I mean your process documentation. Is it overkill? What about walkthroughs? These are big time investment for management and the auditors in terms of conducting meetings, documenting the results, as we just discussed. Also consider whether your controls are optimized. Could you make them more efficient? Could you rationalize them to reduce your control count without exposure to undue financial reporting risks? So when we going back to the rules, it's important to remember the guidance doesn't specify the form or level of detail required. And when I say the guidance, I mean SEC guidance. It doesn't specify the form or level of detail required for the documentation of processes and internal controls or management's assessment of their design. So here are some things to keep in mind. For process documentation, they typically take two forms, either like a narrative or a flow chart. Narratives are very detailed, but they're a lot of work to produce and to keep updated. So, we recommend considering flow charts to get the right level of detail. These are typically preferred by the auditors. They're also easier to maintain once they've been developed. Also review your process documentation to ensure you're only including activities related to significant classes of transactions. So this goes back to your scoping. If you've changed your significant, if you've changed your scoping during the risk assessment, make sure that you're not spending a lot of time updating your control documentation for things that are out of scope. And also make sure you're only covering the process from the initiation of a transaction to recording it. Anything else is too much and is unnecessary. When it comes to walkthroughs, keep in mind that yes, they are an effective way to assess control design, but they're not actually required. Ask yourself, do we even need them? Could we just do talk-throughs, which is more, more inquiry-based, especially if there are no significant changes? If we've done separate auditor walkthroughs in the past, could those be combined with our internal ones? When controls or processes were more, are immature, pre-walkthroughs, like internal pre-walkthroughs before the auditor walkthroughs, may be essential. But once controls are established and control owners are comfortable and they know what they're doing, joint walkthroughs might be more efficient. If formal walkthroughs do need to be documented, then make sure you're looking at how detailed they need to be. And is the auditor's template really necessary, especially if they're not relying on your control design assessment? This is an area where there is such a wide range of cost options. There's a ton of room for reducing costs in this area. As companies' SOX programs evolve, controls are added to address new financial statement risks, new accounting standards, or in response to auditor concerns. But it's important to challenge whether those controls are still necessary in a subsequent year. So when attempting to rationalize controls, you want to review your control mapping to identify redundant controls or controls that are no longer key due to changes in the business, and to consider whether you have the right balance of transaction level preventative controls versus monitoring detective type controls. Rationalizing is more than just trying to get the control count down. It's about making sure you have the right number of controls and the right balance of controls to keep your financial reporting risks at an acceptable level, but in the most efficient way possible. You want just enough assurance. There's no rewards for doing more than what's actually necessary. There's no SOXs, so you don't get an award if you have the most controls or the best controls. It's also important to optimize your controls, which of course sounds like a consulting word, right? What does it mean? Examples of optimizing include evaluating whether certain manual controls could be automated, and leveraging existing controls or augmenting those controls to address new risks before conceding to implementing additional controls. There will always be a new concern from the auditor. There'll always be a new risk. So it's important to try to continually optimize or try to leverage your existing controls. All right. This last slide is just intended to highlight the impact of reducing your control count, which has a compound effect on SOX costs and effort. When you reduce control count, there's time saved by internal personnel in documenting the performance of the control, and then there's time saved on the compliance side in the design assessment and the testing. As you can see here, 20 hours per control adds up pretty quickly. Now, before you start just deleting controls, keep in mind that for certain controls, you may just want to make them non-key, so they're still being performed, but they're not subject to the assessment and documentation requirement of SOX. Also, referring back to our system scoping comments, before you dekey a control, make sure any controls that are being dekeyed aren't being relied upon to keep a system out of scope on the IT side. You don't want to end up in a situation where you got rid of one control and now you have to scope in an entire system. All right, with that, it looks like we have another polling question. Emily?
Yep, 1 second here while I pull that up. Our final polling question: which of the following should be evaluated when trying to increase efficiency in the internal control testing phase? You can select all that apply. Your options are A, the nature of testing, B, timing of testing, C, design of controls, D, extent of testing, or E, significant account scoping. So once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window beneath the slide view. I'll give everyone another moment to think on this. right, let's go ahead and take a look at the results. Matt, back to you.
I missed the results. Can you pull them back up?
No problem. There you go.
Okay. All right, it looks like, so I'm just reading the question again. Sorry, guys. Nature of testing, timing of testing, design, extent of testing, and significant account scoping. Which one of those, let's see, looks like the most popular answer was the design of controls. I would agree that I think design is where we see the most kind of time saving. All right, Francisco, I'll turn it over to you.
Thank you, Matt. So I think we need to go back to slide 38 to talk about testing strategies. Okay, perfect. Sorry. There you go. Sorry about that. We'll move on to, there you go, testing strategies. So one thing to add before we jump into this one. So if, worst case scenario, you cannot rationalize or optimize a control, it's still always good to look at the frequency of the control. One thing that I've always seen is some companies perform a control on a monthly basis that can be done on a quarterly basis, or a quarterly control that can be done semi-annually or annually. A very good example of that would be user access review. For higher risk system, the expectation is you're going to be performing user access reviews on a quarterly basis. However, if it's a lower risk system, for example, your bank account or your banking, your ADP, Equity Edge, wherein there is a lower risk or a smaller number of users, then you may be able to negotiate performing the user access review on a more less frequent basis. It could be done semi-annually or annually. Okay, so we'll jump into the testing strategy. So phase 3, this is an area wherein we spend a lot of time with the SOX 404. This is where most of the cost is, because the number of controls pretty much dictates the number of hours that we spend in executing or complying with the SOX 404 compliance program. So this is an area wherein there could be a lot of time savings. Here, we'll not dwell on this slide very, very long, but just gives you an option between minimum, limited, expanded, and full. Full testing generally would be if you're under 404B, you have to follow the requirements, particularly from the external auditor's perspective. Minimum, limited, expanded, this is something management can do as for part of its self-assessment. Okay. So when we are evaluating internal control operating effectiveness testing, there are 3 areas that we can look at to see whether there are opportunities for cost saving. One of them would be the nature of the testing, timing, and extent of testing. As I mentioned earlier, the SEC interpretative release 338810 gives management a lot of flexibility and leeway on how it would execute its assessment process. So assuming it's under 404A, or if it's a non-rely control, there is that approach that we can use. Obviously, if it's under 404B, there's not much a lot we can do in terms of nature, timing, and extent, because that's generally driven by the external auditors' methodology and the PCAOB. So if they are relying on our testing, we do have to follow their sampling, how they want it to be tested, and what period we're testing. But for management assessment, I would say half of the control. Generally, you can be more flexible in designing your test procedures to kind of lessen the effort needed for those controls. So the nature of the testing, it is referring to the testing method. It's either an inquiry, where you inquire whether the control operates or not. It's almost similar to a self-assessment or a facilitated self-assessment. Then the next one would be observation, where you go in and observe the actual operation of the controls. It's mostly done for application controls. Inspection of relevant documentation. We do obtain a document and look at the evidence, signatures, checklists, all of that. And then reperformance. You go ahead and select a sample document and actually reperform the control to make sure that it was done properly. For the audit of ICFR under PCAOB, inquiry alone is not sufficient. So it should be inquiry plus an additional procedure. It doesn't necessarily describe what is the specific test, but the higher the level of the risk on the control, the more evidence or more need for inspection or performance. Okay, so the evidence for management assessment of the effective operation of controls can either be through direct testing or ongoing monitoring activities. That is, ongoing monitoring activities is allowed under the SEC guidance, so including management's daily interaction of the controls. So for more mature companies, I've seen is for larger organization, they don't do testing, they only do self-assessment, wherein the control owners will attest that the operation of the control. Obviously, under that method, the internal audit does not perform any independent testing. They just rely on that assessment. An external auditor cannot rely on that. They have to do their own independent testing for all of their own key control. As the risk increases, organizations should consider obtaining evidence through personnel who are more objective if you are doing that self-assessment, or through periodic assessment of the control, wherein you have an internal audit team or an outsourced internal audit that tests the operations of the controls. And this is, I would say, something I would recommend for companies that are not mature enough, because you want to demonstrate that the controls are really existing and operating effectively. If the company is mature, wherein the controls really operate in such rigor that it is consistently, and there's no history of failure, then you can update the nature of your testing to kind of lessen the amount of effort for those. You also have to evaluate if the testing approach is commensurate to the risk, right? The higher the risk, the more evidence you need. So you tend to be doing more of performance and inspection rather than inquiry and observation. For lower risk, assuming they're non-rely, that's kind of where the challenge is. Usually lower risk controls are rely controls, so you do have to follow the external auditor's testing approach. But if it's a non-reliable and it's a lower risk control, you can do a facilitated self-assessment or a self-assessment. You can downgrade the testing from the performance to inquiry when it's appropriate, particularly year-end updates. And even with performance, you can perform limited performance, right? So for example, a 10Q, 10K tie-out, you don't have to perform the entire 10Q, 10K tie-out. You can just select a certain number of data within the file that you need to perform. Same with a memo, right? Okay, we'll jump into the timing of the testing. Timing of the testing generally is the time of the year where you execute it. The later part of the year you execute the testing, the more it provides an assurance that the controls are working effectively as of year end. Again, for rely control, you have to work with your external auditor on determining what is the proper timing for the testing of the control. For non-rely or lower risk controls, you can test it as soon as possible. So you want to even out the testing to lessen the effort from the internal audit and management at the same time. And determining the number of times you test, right? You need to really do 3 rounds of testing. Can you do it only for 1 round to reduce the admin cost of doing multiple rounds? So there is so many ways you could design the timing of your testing to save on administrative costs, and at the same time the cost that it takes for management to respond to inquiries when you're doing the testing. But again, if it's a rely control, you have to work with your external auditor to make sure that they agree with the period you're testing and the timing of the testing as well, because there might be times wherein they need some of the testing to be done in Q4 or after year end. Okay, we'll move on. So timing of the testing, consider testing lower risk controls earlier in the year. That's one option. You can require on inquiry or self-assessment as you go towards end of the year. And then consider distributing your testing between monthly and quarterly instead of testing it all once to kind of even out the effort. Okay, and then the extent of testing, I'll do it very quickly. Extent of testing is the number of times or samples you test, right? So for example, on a daily control, some external audit firms will test 25 samples, some external audit firms will test 60, depending on the risk level of the control. So same thing for a rely control, you have to follow the external auditor's requirement, because if you don't follow it, they have to do their own testing anyway. You have to make sure that you follow the extent of the testing. For management self-assessment, for non-rely controls, you can determine what samples you're comfortable with. External auditors may require 25 samples. You could limit to 15 samples. So there's so many ways you could reduce the effort of it, particularly if the external auditors are not relying on that. Okay, and then the other opportunities, I think there was a question about this as well, is the coordinating samples between internal and external auditors. This is really useful. You just have to balance it, right? Particularly for a newer engagement, or you haven't done a SOX program before, we generally recommend that internal auditor performs its testing first to make sure that the controls are designed and operating effectively, even before the external auditor comes in and do their walkthroughs. And the main reason for that is you don't want the external auditors to find deficiencies in your control towards the end of the year before management can demonstrate, because that the control is operating effectively. Because that if the control fails during the walkthrough of the external auditors, you have to remediate it and they have to do another walkthrough again, which compounds the cost of the audit. So you generally want internal auditors to do their testing first, confirm that the controls are designed and effective, and then you can now tell the external auditors these controls are ready for testing. And then in terms of the time spent on the testing, you can also give the internal auditors access to your system in order we can pull the data directly from FlowClass or Blackline, so you don't need to spend time on pulling all those documentation and giving it to us. So that would be, I think, my part. And then I think we have been through these polling questions already.
Hey, Francisco, I wanted to clarify this. When I was going over the responses, I misread the question, so I want to make sure that we get this one right. So the question was, which of the following evaluated when trying to increase efficiency in the testing phase specifically? So the three sort of real answers are A, the nature, B, the timing, and D, the extent of the testing. So the design of controls, this is more of like a textbook question, right? To see if you're paying attention. The design, that's something you'd want to tackle during your design phase 2. By the time you get to testing it, it might be too late. And then is significant account scoping, that's something you want to deal with back in phase 1. So the official answer is A, B, and D. So I just wanted to make sure that we clarified that.
Okay.
And then, all right, so pulling it all together, just wanted to take one last second to talk through, kind of wrapping this up, summarize the key takeaways from today. So what we're hoping you took away and what we want you to kind of think about is, one, take time to understand the difference between the SEC and PCAOB SOX requirements. Hopefully today helped to clarify that, arm you with a little bit more knowledge and a way to talk with your auditors and talk to your other SOX stakeholders. Reevaluate your SOX compliance delivery model. Make sure it's still the most cost-effective way to maintain your SOX program. Challenge some of the old cost assumptions. Maybe you're big enough to bring it in-house now, or maybe a co-sourcing model would be a better fit. Continuously revisit your risk assessment and scoping of significant accounts, locations, systems, and your risk universe. Don't just roll it forward. It might be costing you money. Consider the form and the level of detail in your process and control documentation. There's a question about why flowcharts might be more efficient or the right level of documentation. And really what we see a lot of times with narratives is there's a lot of extraneous details. There's a lot of operational stuff. When you have a flowchart, it's very clear to see where the transaction was initiated and where it was recorded, and allows you to cut out a lot of the extra stuff. Reevaluate the nature, timing, and extent of operating effectiveness testing. And finally, facilitate increased coordination between management's and the external auditor's assessment. Think about giving them access to your system. And with that, I think we are done. There's some questions that we did not get to, and we will make sure that we follow up an email to get those questions answered. Emily, is there anything else that we needed to cover? Any housekeeping items?
I do have some housekeeping items before we go. Thank you, Matt and Francisco, for a great presentation today. As Matt just said, we did have a lot of questions come in, and If we didn't have time to get to your question, we'll be doing our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificates. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.